By the end of this lesson, you will understand the importance of financial management in business and be able to read and interpret financial statements, use financial ratios to evaluate a business's financial performance, and create a budget and financial plan. Welcome to our lesson on financial management in business. Financial management is an essential part of running a successful company, as it involves planning, organizing, and controlling the financial resources of the business. In this lesson, we will discuss the different types of financial statements, how to read and interpret them, and how to use financial ratios to evaluate a business's financial performance. We will also talk about budgeting and financial planning, which are important tools for managing a business's financial resources effectively. Financial statements. There are three main financial statements that businesses use to report their financial performance: the income statement, the balance sheet, and the cash flow statement. The income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a specific period of time, such as a month or a year. The income statement helps investors and managers understand whether the business is generating a profit or a loss. The balance sheet shows a company's assets, liabilities, and equity at a specific point in time. Assets are resources that a business owns, such as cash, equipment, and inventory. Liabilities are debts or obligations that a business owes, such as loans and accounts payable. Equity represents the residual interest in the assets of the business after liabilities are paid. The balance sheet helps investors and managers understand a company's financial position and how it is financed. The cash flow statement shows the flow of cash in and out of a business over a specific period of time. It helps investors and managers understand how the business is generating and using cash and whether it has enough cash to meet its financial obligations. Financial ratios. Financial ratios are useful tools for evaluating a business's financial performance and position. Some common financial ratios include profit margin. This ratio measures the percentage of revenue that a business keeps as profit. It is calculated by dividing net income by revenue. Debt-to-equity ratio. This ratio measures the amount of a company's financing that comes from debt compared to equity. It is calculated by dividing total liabilities by total equity. Return on assets. This ratio measures the efficiency of a business's use of its assets to generate profit. It is calculated by dividing net income by total assets. Budgeting and financial planning. Budgeting is the process of creating a plan for the allocation of a business's financial resources. It helps a business set financial goals and track its progress toward achieving them. Financial planning is the process of creating a long-term strategy for managing a business's financial resources. It involves forecasting future financial needs and developing a plan to meet those needs. Both budgeting and financial planning are important tools for managing a business's financial resources effectively. Financial management is an essential part of running a successful business. By understanding and using financial statements, financial ratios, budgeting, and financial planning tools, businesses can make informed decisions about their financial resources and achieve their financial goals. I hope this lesson has helped understand the importance of financial management in business. If you have any questions, ask them in the comment section and I will answer them as soon as I can. Thanks for watching and I'll see you in our next video.